Understanding balance sheets. In this reading, we talk about the components and format of the balance sheet, current assets and current liabilities, non-current assets, non-current liabilities, equity, and finally, analysis of the balance sheet. Under IFRS, the balance sheet is referred to as the statement of financial position. Balance sheet is generally a US GAAP term. The balance sheet provides information on a company's resources, which are the assets, and its sources of capital, liability, and equity. The concept here is fairly straightforward. The assets, typically shown on the left side of the balance sheet, tell us what resources a company has, and obviously we need to account for where these resources came from, and that accounting comes on the right, in the sense that the money for these assets either comes through debt or equity. Liabilities represent the debt-based financing, and equity represents the equity-based financing. So to purchase these assets, either owners need to contribute money, which is equity, or money needs to be borrowed in some form, and that is liability. The total amount of assets has to equal the money that comes through liabilities or through equity. Different items of assets and liabilities may be measured differently. Some items might be shown at fair value, other items may be shown at historical cost, and one aspect of this reading as well as subsequent readings is to understand the measurement basis of various items on the balance sheet. Components and format of the balance sheet. Here is material that you have seen in an earlier reading. I will not read this for you. You need to simply pause the video and make sure you go through this. But essentially, assets are the resources of a company which will provide future benefits. Liabilities are the obligations, and equity represents the differential between assets and liabilities. The balance sheet shows a company's assets, liabilities, and equity on a particular date, which is typically the last date of a reporting period. As mentioned before, the measurement basis varies across items. This makes life interesting for the financial analyst who needs to understand the measurement basis for every single item on the balance sheet. Some items are shown at current fair value, and obviously the current value is the value at the end of the reporting period, which will be shown in the title of the balance sheet. So that's the current value on, say, 31st December 2010, if that is the end of the reporting period, and not the value when you as an analyst are looking at the balance sheet. Important elements of a company's ability to generate future cash flows are not shown on the balance sheet. If you take a services company such as McKinsey, obviously their value or their ability to generate cash flows comes primarily from the human capital of the company, and elements such as human capital are not shown on the balance sheet. The balance sheet can be presented in different ways. Either we can show assets and liabilities as current and non-current. This presentation is called a classified balance sheet, or we can have a liquidity-based presentation. What you are looking at here is a simple classified balance sheet where the assets are shown as current assets, so that's a classification. Then long-term investments, property, plant and equipment, and so on, all these are non-current assets. Liabilities are also shown as current liabilities and non-current or long-term liabilities. So this is a classified balance sheet. Often banks present their balance sheet using a liquidity-based presentation. Here, with a liquidity-based presentation, assets and liabilities are shown based on liquidity. So here we are looking at assets shown from most liquid to least liquid. Generally, banks present their balance sheets using a liquidity-based format. Moving now to current assets. Current assets are those assets held primarily for trading or expected to be sold, used up, or otherwise realized in cash within 1 year or one operating business cycle. Here are the classic examples of current assets that you need to memorize: cash and cash equivalents. Cash equivalents are highly liquid short-term investments that are so close to maturity, the risk is minimal that their value will change significantly with changes in interest rates. So key is that they are highly liquid. Cash equivalents are generally financial assets. They are reported at fair value or amortized cost. The concept of amortized cost is something that we will cover later in this topic. Marketable securities are also financial assets and include publicly traded debt and equity instruments. So these would be bonds issued by companies as an example, and these would be stocks. Trade receivables or accounts receivables are another form of a current asset. We need to also understand the concept of allowance for doubtful accounts. We looked at these from an expense perspective earlier. Here we are taking a balance sheet perspective. Let's say that customers owe you 100. This would be a accounts receivable. You have made the sale and it's a credit sale, so the receivables is 100. However, there is an allowance for doubtful accounts because you expect that out of this 100, 5 will not be paid. This 5 is the allowance for doubtful accounts. This is called a contra asset account because it reduces the value of the asset. So your net accounts receivable is 95. Inventories are also considered a current asset, and this item, inventories, will be discussed in a lot more detail in a later reading. Other current assets such as prepaid expenses are also shown on the balance sheet as a current asset. If you have a rent expense for a given period and that rent is paid right up front, that is an asset because now you do not need to pay that expense once it has been paid. Current liabilities. These are liabilities which are expected to be settled within 1 year or one operating business cycle. Here are the classic current liabilities that you need to memorize. All assets that are not current are by definition non-current. They are also called long-term or long-lived assets. And here are the types of non-current assets. On this slide, we very briefly look at property, plant and equipment, investment property and intangible assets. Property, plant and equipment are obviously tangible. It is expected that this asset will provide an economic benefit over more than one fiscal period. In terms of valuation or in terms of measurement basis, IFRS says that we can use the cost model or revaluation model. The cost model is straightforward. We report property, plant and equipment at historical cost less depreciation. That's the cost model. And this number, the historical cost less depreciation, is also called amortized cost. Land is not depreciated. Note that the choice between cost model and revaluation model is only provided by IFRS. US GAAP says that we are only allowed to use the cost model. Investment property. This is property that is not used in the regular operations of a company. So If you have a given company that has purchased property in another location and that property has nothing to do with the core operation, then that property has to be marked as investment property, and there are accounting rules and valuation rules for an investment property which we will study later. This concept of investment property is only in IFRS. US GAAP does not mention this term. Intangible assets are identifiable non-monetary assets without physical substance. Classic examples of intangible assets would be copyrights and patents. According to IFRS, we report intangible assets using the cost model or revaluation model. US GAAP allows only the cost model. These items will be covered in detail later when we do the reading on long-lived assets. Goodwill is another item that you might see on the assets side of a balance sheet. Goodwill arises when one company is purchased by another company. So note this point, you can only have goodwill when there is a purchase. If the purchase price is greater than the fair value at acquisition, then goodwill is created in the acquirer's balance sheet. Once you have reported goodwill, it is subject to impairment, and impairment is a concept that we'll discuss later, but very simplistically, impairment is a mechanism for reducing the value of an asset. Let us understand how goodwill is created. Let's say you have company A which buys company T, and this purchase takes place for 100 million. The book value of company T's assets and liabilities are 125 million and 75 million, which means that the net book value or equity is 50 million. However, the fair value of company T's assets and liabilities are 160 and 75 million. As we've discussed before, there might be some items on the balance sheet which are not reported at fair value, which is why there is typically going to be a difference between fair value and book value, and we note that over here. The fair value of assets is 160. The fair value of liabilities happens to be the same as the book value of liabilities. So the net fair value is equal to 160 minus 75, which is 85. When company A purchases company T, what really matters is the fair values and not the book values. Note that company A has paid 100, which is more than the fair value of the net assets. The additional amount that the company paid, that additional amount of 15 million, which was paid above the fair value of the net assets, is goodwill. And as the term implies, this extra amount is paid because of the goodwill that company T has generated. Now, company T might have lots of satisfied customers. They might have a very good brand, which is why the value for the overall company is more than simply the net assets that it has. Moving now to financial assets, and I think this is one of the most testable elements from this reading. IFRS define a financial instrument as a contract that gives rise to a financial asset of one company and a financial liability or equity instrument of another entity. The measurement basis depends on how the financial asset is categorized. Before we get into the different categories and the measurement basis, let's just understand this simple point over here. Let's say you have a given company such as General Electric, which issues a bond. When General Electric issues a bond, it is borrowing money. So for General Electric, the bond is a liability. If you have another company, let's say Oracle, which purchases this bond, then for Oracle, this bond is a asset. And that is what we mean over here, that a financial asset of one company, here the bond is a financial asset for Oracle, but that same bond is a liability for General Electric. The question now is, how should Oracle account for this bond? And the answer is that it depends on how the bond is going to be categorized. Broadly speaking, there are three major categories that you need to worry about: held for trading, available for sale, and held to maturity. If this instrument is classified as held for trading, then on the balance sheet it should be shown at fair value. Obviously, this is the fair value on reporting date. And if the bond value has changed since purchase and the bond has not been sold, that means we have unrealized gains or losses. These unrealized gains or losses must be shown on the income statement. Just to understand this categorization, held for trading means that the intent of the company which has purchased the asset is to trade. In other words, the company is saying that if the price of the bond goes up or if the market conditions are suitable, then the bond will be sold or traded. If that is the intent, then the bond has to be classified as held for trading. I'll come back to AFS in a minute. First, let's talk about held to maturity. If this is a 10-year bond and Oracle plans to hold this 10-year bond till maturity, then it is going to be classified as held to maturity. Here, the treatment on the balance sheet is to record the bond at cost or amortized cost. The concept of amortized cost will be discussed later. At this stage, for simplicity, we will say that the bond is shown at cost on the balance sheet. In other words, if the market price of the bond changes, we do not reflect any market price changes or fair value changes on the balance sheet. Unrealized gains are not recorded anywhere. In between held to maturity and held for trading is this category called AFS, or available for sale. You might recall this term from the earlier reading. With AFS, the company might not be sure yet whether it plans to trade the instrument or whether it plans to hold the instrument to maturity. So you can think of it as an in-between category. If you get a question such as this on the exam, you will be told what the categorization is, and generally you will be asked to come up with the accounting treatment. If a bond or a financial asset is classified as AFS, then on the balance sheet it is measured at fair value. Any unrealized gains or losses are shown in other comprehensive income. This is a part of equity. If the instrument is sold and we have realized gains, then those realized gains are shown on the income statement for all categories. All categories being held for trading, AFS, and HTM. You might already know this, but just to emphasize an important point, when you purchase an asset, say for 100, and the value goes up to 102, and you still have the asset, this increase of 2 is called a unrealized gain. If you actually sell the asset for 102, then the gain of 2 is realized. And realized gains, no matter what the category, are going to be shown on the income statement. Unrealized gains are shown on the income statement only if the instrument is categorized as held for trading. There is another important term that you need to know, which is mark to market. Note that for held for trading and AFS, we are saying that the instrument needs to be measured at fair value. That means that even if you bought the instrument for 100 and now the value goes to 102, then on the balance sheet, the instrument needs to be shown at current fair value. This process of showing the instrument at current market value is called mark to market. This example will help clarify the concepts we are talking about. Let's say company owners contribute 100,000, which is invested in a 20-year bond with a 5% coupon paid semi-annually. After 6 months, the company receives the first coupon payment of 2,500. At this stage, the market price has increased to 102,000. Show the balance sheet and income statement treatment under each of the following categorizations. Now, note that on the balance sheet, initially let's say we are the owners, so we make a contribution of 100,000, and that 100,000 is immediately invested in a bond. This question is asking us about what we report at the end of the 6-month period on the balance sheet and what we report on the income statement related to this 6-month period. Let's first take the held for trading scenario. The cash at the end of 6 months is going to be 2,500. This is the cash that we receive from the coupon payment. So the cash is going to be 2,500. On the balance sheet, we show the cost of the security, which is 100,000, plus the unrealized gain or loss. In this case, the security went from 100,000 to 102,000, so we have an unrealized gain of 2,000. Note that effectively we are showing 102,000 on the balance sheet, and this connects with what we just talked about, that the current fair value of the asset needs to be shown on the balance sheet. Before we come to the equity segment of the balance sheet, let's just look at what's happening on the income statement. The interest income of 2,500 is going to be shown. This is a realized income because we've actually received the money. The unrealized gain is also going to be shown on the income statement because this is held for trading. So the unrealized gain is 2,000. This entire amount reflects our net income. Let's say that this entire net income is retained. So this comes to our balance sheet as retained earnings. The paid in capital, which is that initial contribution, is 100,000. And in this particular case, held for trading, there is no OCI. Notice that the balance sheet balances. On the asset side, we have 104,500, and on the equity side, we also have 104,500. There are no liabilities. Now I want you to pause the video and come up with the numbers for AFS and held to maturity. Here is what you should come up with. With AFS, the cash again is 2,500 because that's the coupon payment that we are receiving. The cost of securities, 100,000, that's the original purchase amount. Remember that with AFS we said that the item is going to be shown at current market value. So the unrealized gain of 2,000 is shown on the balance sheet. We also said that with AFS, the unrealized gain is not shown on the income statement. So notice on the income statement, we only show the interest income. So this is only the interest income on the income statement. The unrealized gain of 2,000 is shown as OCI, and OCI is part of equity. So OCI goes up by 2,000. The retained earnings of 2,500 are coming from here, and the paid in capital is 100,000 as before. So here again the balance sheet balances, but notice the difference between held for trading and AFS. The critical difference is that unrealized gain with held for trading is shown on the income statement, but with AFS, the unrealized gain is shown straight in the equity segment under other comprehensive income. This should also connect with the example that we studied at the end of the previous reading. With held to maturity, our treatment is the simplest because we completely ignore any unrealized gains. Cash goes up by 2,500 because that is the coupon that we actually receive. The cost of the security is shown 100,000. We do not show any unrealized gains. The paid in capital is 100,000 as before. The retained earnings of 2,500 come from the interest income that we generated, and we are assuming that all of that was retained. You need to understand this example very well. As I said before, I think this is highly testable. Here is a summary of how financial assets are classified and measured. We have already talked about the most important and most testable items, but for completeness, you can also read the other items shown here. Non-current liabilities. All liabilities that are not classified as current are non-current. Under long-term financial liabilities, we can have loans, notes, bonds payables. We can also have deferred tax liabilities. These result from temporary timing difference between a company's income as reported for tax purposes and income as reported for financial statement purposes. In case your head is spinning, that's all right, because there is a full reading on this material later. That reading is called income taxes and long-term liabilities or non-current liabilities. This is also a reading that we will cover later.